The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading.
For over 95 years, we've set the bar. Power, we restored it. Protection, we reinvented it. Record yields, we redefined it. If there's one thing we know at FS, it's that just because something hasn't been done, doesn't mean it can't be done. We're never satisfied unless we take your farming operation to the next level. Run your equipment at peak efficiency and bust the bins this season. Visit fssystem.com.
Well, it was a mostly quiet market trade seen on the day Wednesday in the grains and oil seeds, a little bit higher in wheat and corn. Beans got pulled a bit higher with a decent day in bean oil. Overall, though, it was a much different reaction a day after the September WASDE report than what I was expecting in the trade. Here to provide us with analysis and his thoughts of what we saw on Wednesday's session and kind of recapping and following up on the WASDE, Mike Zuzolo with Global Commodity Analytics joins us here today. Mike, always good to chat with you. And, kind of a quiet day Wednesday overall in the grain trade. I was a bit surprised considering what we got with the WASDE on Tuesday.
Yeah, running a bit pins and needles on the soybean trade, Jesse, with the trade continuing to make some new lows and take out last week's low from Friday and press down to some major support levels that, really absolutely have to hold. I don't like the seasonality of what the USDA did in terms of the report. And what I mean by that is we're really running into some very early harvest, and it's going to go very hard. We're going to be feeling like we're in the middle of harvest probably a week from today when you and I talk, just because of how fast things are drying down. Between that and the fact that we didn't get any kind of real cut at all, sizable cut in corn at all, and just a small cut in U.S. soybean ending stocks, the U.S. ending stocks numbers for corn and beans and the seasonality and then this speed up of the harvest really made me nervous about soybeans coming into today. I told clients and subscribers yesterday after the report numbers that if you can't find support off of these numbers in wheat and after the European market got off the board on the September contract, I'm not sure what will help us at this point. And we're going to have to wait until the September 29th stocks report. So I'm feeling better, but I don't think we're out of the woods. One day doesn't make a trend.
Very, very true. Well, I want to talk a little bit about the wheat side here. That seemed like the winner of the day. It looked like to me maybe a bit of short covering. I mean, as you look at the wheat trade as a whole here, you mentioned some of those European values. Let's dissect some of these numbers a little bit more. Walk us through what you're seeing with this overall global balance sheet.
Yeah, this is the bigger picture graphic that I wanted to provide to your viewers today, because one of the biggest things that we're seeing a difference in after the report from USDA is that major exporters, our major competitors who have been such a thorn in our side, all of them combined at this point, the traditional major competitors will only have about 315 million tons of production in this upcoming marketing year that we're in right now in the wheat, on a production number that is very close and only, is the second highest in the world in the last 4 marketing years. And so that puts us, especially given our U.S. production number, which I still think is a little bit too high. I think USDA got a little bit away from it with the soft red wheat. But between that and the fact that we are seeing a real change in the European market, these production numbers going down 6 million metric tons yesterday versus the August report was in almost every category that we needed it to be, except for Ukraine. And that went up, as you can see on this chart, up about 1.5 million tons. That, however, I think was discounted on Wednesday. In other words, Ukraine came out with some fresh information and said between the middle of July and early September, they have had about 105 grain infrastructure facilities targeted, and they've lost 500,000 tons of export capacity on the Danube River ports out to the export market versus what they had before all of these attacks. And so I think the trade's back to understanding this Ukraine-Russia war is still limiting the impact of the market. And I think that in turn helped us, along with the September expiration in Europe and the Paris wheat market, helped us really bounce like a rubber ball off the $6 a bushel equivalent price action with D's taking over. And notice with D's taking over in European wheat, we're back to almost $7 on this chart.
And looking at this chart and looking through those other charts that we just showed here, looking at all the different world numbers, I have to wonder here, Mike, are we feeling like maybe we are putting some sort of a bottom into this market, or are we still searching for a bottom here in wheat? What's your thoughts on that?
Well, really the biggest thing that we continue to fight, other than the Russia-Ukraine situation and that being underpriced, in my opinion, Jesse, has been the Federal Reserve and the interest rates. And we'll get a great big piece of news on that when it comes to the end of the month with the Federal Reserve coming out. And what we really need now at this point is a peak in the dollar. I think that changes the dynamic. First things, though, look at this chart, or excuse me, I was going to say, look at this chart on world stocks to use, the very last column, 32.5%. That puts us down to a 10-year low of 32.3%. We're dancing on the lowest levels since 2012 when it comes to world stocks to use ratios. And so if we could get a peak in the dollar, I think we'd be primed for some increased exports. So first thing to get after in terms of hard red wheat is to take out the current monthly high of this September month of around 752 3/4. That starts the technical ball rolling, in my opinion.
Let's go back to the soybeans here. As we saw beans, I liked how we rallied off of the lows on the day, Wednesday. Some of that good strength of bean oil, I think, helped. But as you assess this soybean market now post-WASDE report, Mike, what are you seeing on the charts? What does the technicals tell you here with the soybean balance sheet and more?
Yeah, I could have kept the label off of this chart and turned the background black, and it would have looked a lot like that Bloomberg grain commodity index that we look at almost every week. So it's no coincidence, I don't think, Jesse, that we're seeing a major pennant, a major wedge form here in the soybean complex again. And so this takes that lead month futures price, very important to hold that 1320, 1318 area as September goes off the board on Friday. And that's very important from a standpoint of the charts. It's very important from a standpoint of the trade sentiment in terms of, are we going to see an increasing likelihood of reduced yield? The way I would lay this month out going into the second half of September, if we stay wide open in the harvest, the two things that matter to me, we've already talked about, wheat and the dollar, as far as providing leadership on the macro side. The second thing would be the yields. And if those yields come in lower than expected the next 2 weeks in corn and beans, I think that could present an issue where the trade would not want to take this market and break it lower out of this wedge formation. Going down to what USDA did and just looking at it from a general perspective of yesterday's report, we're now down to around 2022 levels in the corn yield. 173.3 was last year. We're at 173.8. We are well above last year's bean level, and that doesn't make any sense at all if you look at the weather of the last 30 days and the satellite imagery. And so if you would go, say, down to a 49.3 bushel yield on soybeans, that'd take about 62 million bushels off the ending stocks number. If you didn't change anything else, that takes you down to a 160 yield. That justifies $13 plus beans. So that's kind of where I'm looking at it, is I want to see us stay strong into the end of the month. Then I think we can find some support from some other factors.
You mentioned the dollar there a little bit. I'm just curious your thoughts on the consumer price index data that came out on Wednesday morning. It looked a bit hotter than I think some folks anticipated. What's your thoughts there? I know we got the Fed getting ready to meet. It just seems like inflation's sticking around with us here, Mike.
Yeah, you're right. It was hotter than what a lot of people thought, and it was because of gasoline prices. Yep. We're stuck at almost $4 a gallon. Thankfully, the diesel market is not moving as fast to the upside as the unleaded market is, Jesse. But at $4 a gallon, that's 8.5% higher than last year at this time. It really does put back on the table the Federal Reserve saying something that could make the dollar go up another leg. And that's kind of like the opposite of what we saw in the USDA report yesterday. We were making new 3-year lows in the wheat. The wheat got the most bullish report. All of a sudden, they're realizing in the trade they overshot the mark. They sold too hard. I'm very nervous now after the CPI data that the Fed will set us up for another leg higher in the dollar. And therefore, we do have to wait until the end of the month to really signal kind of the all clear. We'll not only have the Fed past us, but as I said, we should have a lot of harvest data past us. And I think everybody, you've probably heard the same thing. I think everybody's pretty much universally agreeing the earliest stuff should be the best stuff this year, especially when it comes to the corn.
We're having a conversation today with Mike Zuzolo from Global Commodity Analytics. Mike, I want to touch on corn a little more here just for a second. This will help parlay us into a cattle discussion here today. You and I were chatting just real briefly before we went on the air. I was a bit surprised that there was no cut to export demand for corn from USDA. And you mentioned to me, that big acreage number that we got, that big jump in corn acres. So curious, this corn market. Yeah, 173 definitely is not, bullish. I'd say that's a bearish yield estimate at this point. I don't know. I was a little perplexed with some of the numbers that USDA gave us on the corn side.
I agree with you. I think that the idea that we could see a demand cut next month can't be ruled out, Jesse, because one thing that I think I underestimated in this market was the size of the Brazilian crop. I really didn't think that second crop corn could get much above 95, 98 million metric tons. And it's just been, it sounds like a whopper of a crop. And so we'll continue to see them work against us. I still think that at the end of the day, sidelining what you just talked about on the supply demand side, and I'll go back to that in a minute, but I still think about 30 to 40% of the price decline in corn has been directly related to the funds and the wheat market. And so I think that if we really found a long-term low in the wheat and a long-term high in the dollar, the corn market could withstand a demand decrease next month. The other thing I would point out that doesn't make a lot of sense to me right now, and that I think that we're going to have to clean up as a trade, is Atchison new crop corn right now for October off the combines $4.25. USDA's got a $4.90 average price, kept it the same versus August. I know we went really high early in the year, but we're kind of scraping the bottom of the barrel on futures price to keep that $4.90 price average intact. And so either we're done going down or we're going to have to watch that average price a lot closer. And I'm inclined to think that we could see another yield decline because I still don't think they've got Iowa quite right yet. So that's my quick and dirty on the corn side of the equation. The corn is a much more of a global feature, though. To me, it's so much more like wheat than the soybeans are right now.
Fair enough. No, I do appreciate the thoughts there. Well, and let's parlay the corn discussion into the feeder cattle market as well. I'll pull up another chart on the video feed looking at a feeder corn ratio here for lead month futures. What's your assessment? What's your analysis of the relationship right now between the feeder market and corn?
Yeah, this is where if the wheat market makes a low this month and we have an early low in the corn, an early harvest low in the corn, and I suggest that because I'm not deaf to the clients who've been calling in wondering if they shouldn't buy corn to protect their crop insurance price because it's so much higher than where we're at right now. This ratio would suggest you're up there in terms of the feeders premium to the corn. And if the feed grains are going to turn, that's very, very important compared to last year or the last 5 years. And what I mean by that is the funds have really stuck into and been very serious the last year about buying protein and selling grains, and that protein would include the soybeans. And I'm wondering if we're not running that dog too hard and we're getting ready to change that dynamic to where they pull off of the long protein, short grain mindset. And if that's the case, feeder cattle clients really need to watch because the feeders have their own fundamentals. If we don't have as bad of a drought situation because we get rains in the plains, which is starting to happen, if we see that the feeder cattle, who the funds I think have bought really aggressively against the corn, that starts to unwind itself. I think we really got to be ready for that 2014 type high, maybe feeders leading it. And so this is kind of a red flag moment for me to say, look, we've got weaker exports from USDA in both beef and pork. We can talk about that in a minute. But the critical thing is we've not only got a higher gas price, we not only have maybe the potential of a recession in Q4, now we've got the potential for a 10-year low in stocks to use in wheat, and it's unlikely that's going to be a feed grain. So we really need to watch that as livestock producers.
Well, you mentioned those lower exports as well. I'll flip over charts here and look at the December live cattle continuation chart. And I think that could rope into this discussion as well about the fat cattle market here, Mike. Very interested. Just your thoughts overall here as we've gotten out of, you like to put it, the BLT seasonal here for, summer grilling season's kind of wrapping up. Exports down, demand could be moving lower into the holidays for certain cuts. So I don't know, a lot to unpack here. What's your thoughts?
CPI data did not hurt us today, Jesse, but I think what did hurt us, and we're going to have to factor this in probably unless we see a much lighter kill develop week over week, is 23 beef exports were cut 160 million pounds yesterday versus last month. That's a 5% cut in 1 month. Imports were increased 35 million pounds for the beef side. They cut exports 70 million pounds for 2024 and added 30 million pounds in imports. And so you're talking about almost 200 million pounds additional supply in this year yet, and 100 more million next year. It really does, again, raise the caution flag that we are limiting the consumption. Our strong dollar is going to impact us negatively with increased imports from both Australia and Brazil. And USDA even increased the pork imports by 35 million pounds for 23 yesterday, and they increased it another 30 for 2024. So I think we really got to be careful here, and we've talked about this a lot about how the October timeframe was where the major highs were made back in the 2015 cycle. I really want this Dees cattle chart to break higher and break that 189.25 high from the July market that we made, and we're testing it now. So I think by the end of this month, we're still on track for hedging Q4 cattle.
I was going to say, because, you and I've talked about this, and I still hear a lot of chatter. A lot of folks are wondering if they shouldn't be a hedger here at these levels. And just looking at this overall market sentiment, we think about, I just think even this past couple of weeks, cash cattle activity has been pretty light. We're waiting to see if any uptick is had there. I just have to wonder, what's that cattle supply looking like out in the country? How are things going to look here at a Q4? What's that going to do to this market? Or are we finding kind of a top here? So everything you're talking about just got me a little perplexed in this cattle market overall, Mike.
Well, I think what you're feeling, and it's right on the money, you're feeling the drought, and you're feeling the situation with the heat, and you're feeling the situation of, did we lose a lot of cattle and death loss? Are we not gaining in cattle? And so therefore our marketings are extra current. And so therefore we are headed higher. I think those are all valid issues, but I think at the end of the day, like we talked about last week, it's like $8 corn right now in the fat cattle market for Q4. I mean, Kansas State's last numbers were well north of $200 a head for November marketings in terms of profit, and banging on the $175, $180 a head profit for December. And we're at 189-ish on December fat cattle. USDA's got a 190 price point for the five average weighted steer average price. So we're pretty much there, and the profit is really high. So I just like would like to get puts underneath me in both soybeans and cattle if I see the market opportunity.
Fantastic. Well, Mike, before we let you go, anything final you want to mention or reiterate to folks here today? A lot of ground we covered here on the show today. Anything else you want to mention?
I'd really like to see the European wheat and the hard red wheat finish very strong this week, Jesse. I think that gives the corn and beans a lot more leeway as we wait for more yields.
Fantastic. And if folks want to reach out to you, they want to look at your analysis and much more, I know they can do all that pretty easily online, can't they, Mike?
Yeah, go to globalcomresearch.com and take out a look at our product services brochure, and also take the time to answer a couple questions and sign up for a 2-week free trial.
globalcomresearch.com. Com has 2 M's in it, by the way. globalcomresearch.com. Mike Zuzolo, Global Commodity Analytics. Always a pleasure, my friend. Thanks for joining me here this week, and have a good one. We'll talk to you next week.
You too, Jesse. Thanks so much.
That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.